The Essays of Warren Buffett Part 4, The Hidden Risk of Safe Investment. In Part 3, we saw that Buffett listens to the real strength of the business, not the voice of the market. For him, a stock is not a blinking number, but a part of ownership. But at the end of Part 3, a new question opened. If a good business is found, the management is honest, and the price feels reasonable, is just this much enough? An investor is sitting with his savings. Three paths lie ahead: bank deposit, gold, and business ownership. All three appear safe, but Buffett asks, who truly creates wealth? Right here, the mystery of Part 4 begins. Because many times, the investment that appears safest is the very one that can slowly and quietly eat away your purchasing power. Buffett views investment alternatives in three categories. The first category is currency-based investments, such as bonds, mortgages, and bank deposits. The common man considers these the safest. The money keeps showing in the account, interest keeps coming, and looking at the principal makes the mind feel calm. But Buffett's question is direct. Is it enough for the money just to remain preserved, or should the value of the money also be preserved? Right here is the hidden risk. If inflation reduces the buying power of your currency, then your money can be nominal-wise safe but real-wise weak. What is available for less money today can become many times more expensive years later. The money remained lying there, but its power decreased. Therefore, Buffett does not blindly consider currency-based investments to be safe. According to him, risk is not just losing the principal, it is also losing the value. Sometimes a high interest rate can cover this loss. But this doesn't happen every time, and the real return after tax can be even smaller. This is the reason why Buffett does not like such assets much as long-term wealth creators. They can give stability, but the fire of compounding can decrease. Now the second category comes, and this is emotionally very powerful. Such assets, which do not produce anything themselves, but people hope that in the future someone else will buy them at a higher price. The most famous name in this category is gold. For centuries, people have considered gold as a safety, status, and crisis hedge. Gold shines, lasts, and gives psychological comfort to people in times of fear. But Buffett's view is different. For him, gold is not a productive asset. It neither runs a factory, nor grows a crop, nor sells a product to a customer. Gold just stays right there. Its value depends on the hope that in the future, some buyer will take it from you at a higher price. Here, Buffett's point is not to insult gold. He just shows that there is a difference between wealth creation and wealth storage. If you buy gold, you are not buying production. You are buying the belief that its demand will continue ahead. Now the third category comes, and this very one is Buffett's favorite. Productive assets, businesses, farms, real estate, things that create something over time. A farm can give crops. A rental property can give rent. A strong business can generate cash flow and earnings. Buffett likes such assets because they do not depend just on price appreciation. They create value from the inside. Right here, the talk of Part 3 connects with Part 4. The market price can change, but the real strength of a productive asset lies in its earning power. If the business is strong, it can adjust prices even in an era of inflation, serve customers, and generate cash. But buying a productive asset is also not an automatic win. A wrong business, wrong price, or wrong industry can give a loss to the investor. This is the place where Buffett gives us a painful example, the airline business. And the interesting thing is that he admitted a mistake here himself as well. Airlines look glamorous from the outside. Planes, journeys, growth, global demand, everything looks impressive. But Buffett understood that demand alone is not enough. If the industry is very competitive, the capital requirement heavy, and pricing power weak, then the profit can get suppressed. He accepted his analysis mistake in the airline investment. Reports might look fine, but if the industry economics are weak, the numbers can deceive. This lesson is very big. A good story and a good business are not always the same thing. Many industries are necessary for customers but can be bad for owners. Airlines become a classic warning sign of this. The joke connected to Richard Branson says the same. To become a millionaire in an airline, one might have to be a billionaire first. This joke sounds funny, but a painful truth lies hidden behind it. Some businesses do generate a lot of revenue, but are able to create less shareholder wealth. Now Buffett talks about junk bonds. The name itself is like a warning, but looking at high interest, investors get attracted. Junk bonds are the debts of those borrowers whose credit quality is weak. The return looks higher, because the risk is also higher. A low credit rating means that there is less trust in the borrower. Therefore, he offers more interest to lure investors. But a high yield is not always a high opportunity. Many times, a high yield is just the price of danger. In 1980, junk bonds became very popular. Many people considered them an easy return, but default risk always remains hidden in a debt with weak credit. Buffett's message is clear. Do not put money just by looking at more interest. First ask, what is the probability of your money coming back? Right here, the real drama of investment alternatives unfolds. A bond appearing safe can become weak from inflation, shiny gold does not produce, and high-yield debt can break down. So what should the investor do? Buffett says, focus on productive assets, but not with closed eyes. You have to understand the business's quality, management, industry competition, capital needs, and long-term economics. This is the reason why Buffett does not get excited just by seeing a low price. He wants that business which can generate real cash over time. Now market psychology comes, and Buffett's most famous thinking comes forward. Be fearful when others are greedy. Be greedy when others are fearful. This line is simple to hear but extremely difficult to follow, because walking opposite to the crowd demands emotional strength. When everyone is buying, prices are going up, and there are success stories in the news, staying away is not easy. And when the market is falling, people are selling in panic, the courage to buy becomes even more difficult. But Buffett does not mean to buy in every crash. He means learn to separate fear and greed from facts. If the fear is more than the business reality, it can become an opportunity. If the greed has gone ahead of the business reality, the danger can increase. Now in the story of returns, another hidden villain comes: helpers. This is understood from Buffett's analogy of a family. Suppose a family owns all the businesses. The businesses are making good money, and the family is quietly becoming wealthy. Then some helpers arrive. They say, buy, sell, rotate, change strategy, we will make you even richer. The family listens to them, transactions begin, fees are charged, taxes arrive, and gradually the total wealth starts decreasing. Then a second group arrives. It says, you need professional managers. They also take fees, and another part is cut from the family's wealth. Buffett explains through this analogy that even if the economy performs well, the investor's net return can still be low. Because in between, fees, trading costs, advisory charges, and management incentives can eat up a share of the wealth. Private equity, hedge funds, and active managers can sometimes add value, but not every helper is free for the investor. If the gross return is good, but the net return after fees is weak, then the investor's real earning decreases. Right here is Buffett's broader warning. In the investment world, activity does not always mean progress. Many times, more action creates only more cost, and more cost silently reduces the speed of compounding. In Part 3, we learn to ignore market noise. In Part 4, Buffett explains that the noise of the investment industry can be just as dangerous. Every new product, every complex fund, every polished strategy can make the investor feel sophisticated. But the question remains the same: what is the net result? Buffett himself states two goals for Berkshire. First, not trying to show the company as overvalued. They want expectations around the true worth of their company. Short-term excitement can be gained from hype, but wrong shareholders might get attracted. The second goal is a long-term partnership. Buffett wants those very people to come into Berkshire who hold an ownership mindset. If the investor thinks of entry-exit every day, the partnership becomes weak. For Buffett, a shareholder is not a trader but a co-owner. This very approach is unusual. Many companies feel happy seeing a higher stock price, whether the price is far above reality. Buffett does not want this. Overvaluation can create future disappointment and build wrong expectations. Now comes the matter of share repurchase. Hearing this, many investors feel happy that the company is buying back its shares. But Buffett puts a condition here as well. A buyback is good only when shares are bought at a price less than the intrinsic value. If a company buys overpriced shares, it is spending the remaining shareholders' money at a wrong price. But if a company buys undervalued shares, the remaining shareholders' ownership percentage can become meaningful. Meaning, just feeling happy seeing a buyback headline is not enough. The question is, was the price right or not? Buffett many times admits that Berkshire had missed opportunities on buybacks, but the principle remained clear. The price should be well below the true value, only then is a repurchase wise. The real test of capital allocation is visible here. Where should the CEO put money in the business, in an acquisition, in debt repayment, in a dividend, or in a buyback? A wrong capital allocation can make even a strong business average. A right allocation can give a better result even to an average opportunity. Therefore, in Buffett's view, the management's job is not just to run operations. Sending capital to the right place is the CEO's biggest responsibility. Now the central payoff of Part 4 is in front of us. The real choice in investment alternatives is not between safe and risky. The real choice is putting money into an asset that creates value and getting stuck in an asset that is safe or attractive only in appearance. A currency-based investment can give you stability, but you will have to fight inflation. Gold can give emotional comfort, but it does not generate cash flow from within itself. Junk bonds can show a high yield, but the reality of a weak borrower can cost you dearly. Industries like airlines can be tough for the shareholder despite demand because competition eats up the profit. And helpers can show your work as easy, but their fees can quietly slow down your compounding. Buffett gives only one lens to the investor in this whole chapter. Can this asset increase real purchasing power and real earning power in the long run? If the answer is unclear, a pause is necessary before excitement. Because the most dangerous thing in investment is that which feels safe, but reduces wealth from the inside. Part 4 explains to us that Buffett's investing is not a magic formula, but a reality test. Ask every asset, what do you produce? Where is your risk hidden? And who all are taking a share in my net return? This very question can separate the ordinary investor from the crowd. Because the crowd often looks at price, yield, and popularity. Buffett looks at quality, productivity, cost, and long-term ownership. And this very difference becomes big over decades. But the story is not complete yet. Because in the next part, the question will not remain just about choosing an asset. In Part 5, Buffett takes us into that world of accounting, valuation, and shareholder value, where profit appearing and wealth being created can be two different things. Because sometimes a company looks strong in the earnings report, but real value does not come into the owner's pocket. And the next secret lies hidden right here. Is the business truly making money, or are the accounting numbers just telling a story to the investor?
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.